So you might be giving to charity, but your tax person has told you, well, it's not enough to itemize your deductions. Or maybe you're giving to charity and didn't even realize that you're not getting a tax deduction for it. So today, we want to walk you through how you could potentially give to charity and get a tax deduction for doing so through a donor-advised fund. So I'm going to use a sample scenario, a hypothetical here, to be able to show you how this all could take place. All right, so here we've got John and Laura's sample, and a lot of this actually doesn't even matter, but just so you have some details behind the scene here. So let's say they're age 64. Again, age doesn't matter. Retiring at age 67. What does matter here is how much they're giving to charity and what does that mean? And then how could they potentially do that in a different way to get a tax deduction? So if you can see here on their total financial health statement, they're giving $5,000 to their church and $15,000 to charities. So they are giving $20,000 total to charitable organizations, but guess what? And I'm going to show you the tax projection. They are not getting a tax deduction. $20,000 going out to charitable organizations, and they are not able to itemize their taxes and get a tax deduction for giving to those charitable organizations. So we're going to walk through today how to do that in a different way, so they're still doing a good thing, giving to a good cause, and lowering their taxes, keeping more of their money with them versus giving it to the IRS. Now, a few other things here. Income sources, they each have $100,000 coming in. If you've seen previous videos, I've thrown up Social Security and 401k contributions. But in this case, it really doesn't matter because really right here is what we're going to talk about. This comes into play too, how much they've got coming in for income. Okay, the second part, and some of this does and does not matter, but just to show you here, right now they've got about $100,000 in savings, $300,000 in brokerage. And again, we're just keeping this very simple today, and we'll say in their 401ks and IRAs, they've got $1 million each. Now, something that does come into play, they do have a residence, and you'll see here that they do not have a mortgage on the residence. So really for today's video, I just want to keep things simple. And you might say, well, I don't give $20,000 to charity. I give less or I give more. Again, keeping it simple, but using maybe some larger numbers here so you can see the impact. And then you can just kind of take this hypothetical example and start feeding in your own numbers, working with your financial professional, your tax person, and seeing if this could then be of benefit to you. All right, so let's take that information and let's feed it into a tax projection. So based on that, what would they potentially owe in taxes? And I'm going to show you the area of, as I mentioned, they're doing a great thing, giving to great causes, but they're not benefiting from it from a tax standpoint. Some of you could say, well, that doesn't matter. It's giving to a good cause, which is totally true. But if there's a way to get a tax deduction for it, hey, we should also take advantage of the IRS rules and programs and different accounts that are out there and available to us. And so here we go. Let's take a look at their tax projection. So if we just go down here, I'm just going to throw out some basic numbers. They've got about $200,000 of wage income coming in. They each are making $100,000. Taxable interest, so they had that money in their brokerage account and their savings account. They've got about $10,000 a year coming in there, and then dividends coming in as well. No IRA distributions, no pensions. They're not taking Social Security yet. We're just keeping it simple, saying that they don't have any gains, short-term or long-term, in their portfolio here. So we're going to continue to go down on this here, and let's take a look right here. We're going to look at our itemized deductions. No medical deductions. I just put in here because yes, they do own their house. Let's just say their property taxes are exactly $10,000. The SALT limit, state and local tax limit, right now has a $10,000 cap on it. And again, all of this could change in any year when Congress changes tax laws or if the Tax Cuts and Jobs Acts expire. So you'd have to kind of go back and review this again. But right now, we want to provide good information based on what you can do. So $10,000 there. And then let's go down here, scroll down a little bit more. You'll see right here, I've put in the $20,000 that they're giving to charitable organizations. So we've got $10,000 here for their call it property taxes, $20,000 here. So that's $30,000 from an itemization standpoint. We're like, that's a lot of money to potentially itemize on their taxes. However, the standard deduction is $32,300. So in their case here, even though they're giving $20,000 a year to charity, they've got their property taxes. I forgot to go through, but they don't have a mortgage. So there's no mortgage interest. Right now, the standard deduction is more than their itemized deduction. So with that being said, they are not itemizing their taxes. They are not getting a tax benefit from giving $20,000 a year to charitable organizations. Now, what if they did something in a different way? And I'm going to show you this. It's called a donor advised fund. A little good scenario here on how does that work. Well, let's just say the donor gives cash or other assets to a donor advised fund. It is an account that they are putting that money into, and then from that account, they're able to grant money to different charities. So I just want to be very clear on this. The year that they put the money into the fund, it is now strictly for charitable organizations. Well, you say, well, if they did 20,000, then wouldn't they be in the same scenario? Correct. But let's go back to John and Laura's sample again. Remember, they had the savings account, they had the brokerage account, they had $400,000 in it. So I'm just going to use one quick scenario. What if they took $40,000, so 2 years, because they've got that savings account, what if they put $40,000 into the donor advised fund? Now, a question that you might have is then, do they have to use that money right away? Do they have to give it to the charities in the year that they put the money in? No. They actually have through their entire lifetime to give that money to different charitable organizations. You might say, well, they were doing $20,000 a year, they'll burn through it in 2 years. Yeah, they would, but they don't have to. So let's just say in year 2, the life changes, things change, and they're like, you know what? We're only going to give $10,000 this year. Well, they can. And then they'll have that remaining funds to give again to charitable organizations through their lifetime. And then the year that they put the money into the donor advised fund, just like it says here, they receive a tax deduction for the year that they put the money into the donor advised fund. So think about it this way a little bit. I'm going to go scroll down here. Tax estimate without donor advised fund, tax estimate with donor advised fund. So if you can see here, without the donor advised fund where they just gave the $20,000, well, instead of getting the tax deduction, they're just going to get the standard deduction, $32,300. But again, if they grouped multiple years into that donor advised fund, put it in there, now they're going to get the larger deduction, the 1 year of $20,000, the other year of $20,000 that they put in there, plus they're going to get that $10,000 from their property taxes. So a $50,000 deduction, which then moves them down to $26,000 in income. So guess what? Just thinking differently now saved them approximately around $4,000 in taxes. Just thinking a little bit differently. Did they have the accounts to do it? They did. Did they have the means to do it? They did. So all they did was just took 2 years and brought it into one, put it into the fund, and now they saved them $4,000 in taxes. So think about that. If they didn't do this, they would have paid $30,000 this year, $30,000 in taxes next year. By doing this, yeah, they will pay $26,000 in taxes this year, and then next year, guess what? They're not, through their regular means, they're not giving to those charities. However, they still get the larger standard deduction. And so yes, they'll revert back to the 30,000s, but instead of 30,000 in taxes and 30,000 taxes, now they're 26 and then followed by the 30. So they're saving $4,000 there. So I want to just kind of multiply this to help you kind of look at it in even larger scenarios. So that way you can kind of see the impacts of, okay, what if I did 3 years or 4 years or 5 years? And so I'm going to have our two scenarios we're just talking about there, our base scenario, as well as if they put 2 years together. And I'm going to say, what if they did 5 years into the donor advised fund? Again, they've got the funds, the means to do it. Now that could give them a tax deduction. So, all right, let's take a look here. We've got 3 columns. The first column is their original tax information. The second column is what if they were to put 2 years into the donor advised fund. And the third column here is what if in that 1 year they took $100,000, so 5 years worth of their charitable donations, and put those into the donor advised fund in the first year. And so if we scroll down again, all the information's the same: wage income, taxable interest. However, when we get through to the itemized deductions, same property taxes, and here's where things change. So this first year, right, the itemized deductions were 10 plus 20 equals 30. Nope, standard deduction actually wins out there. But if they do the donor advised fund, they put 2 years with their charitable deductions there, $40,000, plus the 10 and the property tax. Now they get a $50,000 itemized deduction. Or maybe they say, hey, you know what? We've got the means to do so. We know that we're going to make these donations for the next 1, 2, 3, 4, 5 years. So they put $100,000 into the donor advised fund. We'll take a look at that. Then they're getting a $110,000 itemized deduction in that 1 year. And then all of the other years, they'll still get the larger standard deduction. And if we look through here, and I'm just going to have you focus on this line item here, total tax. So doing nothing, if they would just do nothing about this year after year after year after year, and let's just say, imagine that everything stayed the same, they're always going to owe somewhere around $30,000 in taxes. But thinking differently, and if they mentally were committed that they're going to make these charitable deductions, even just doing 2 years saves them $4,000 in taxes. If they did 5 years, look at that, it saves them around $17,000 in taxes. So again, more money in their pocket, keeping more for them versus giving to the IRS. Plus, just switching things around, so now they get the benefits of not only giving to the charitable organization, but the tax benefits as well. So it's just taking information, thinking differently. I know for some of you might think, oh, he's using big numbers. For some of you might think he's using small numbers. And for some, it might just be the numbers that actually work out with what you use. But either way, hopefully it shows you that there's different ways to achieve potentially giving to a charity and giving a tax deduction. Now, a few things to think about. One, the current standard deduction could potentially expire or is scheduled to expire at the end of 2025. So you might want to be careful with how many years you put into the donor advised fund. But if Congress renews those tax deductions or decides to carry them on, the standard deduction, well then putting more than 2 years in there might make sense. So talk to your tax professional, talk to your financial professional. Some other thoughts. You can use this to donate appreciated securities. So I mentioned they have this brokerage account with $300,000 in it. Let's say they have one stock in there that's really had a lot of gains in it, or a few stocks that have had a lot of gains in it. Well, if they were to sell those stocks and then give the money to charity, guess what? They got to pay capital gains on the stocks before they give them to charity. However, with the donor advised fund, they can take those appreciated stocks and donate them to charity. So that's one thing to think about too. Remember, you don't have to give the money in the year that you do the donor advised fund. You have a lifetime to give that money to different charitable organizations. And then I also like to just kind of throw in this as other thoughts too, is that it really allows flexibility. So if you think about it, if you do a donor advised fund, the year that you do it, you got one receipt. That's all you have to keep track of to give to your tax person. Here's what happened. Here's what took place. And it's pretty simple from a tax standpoint versus giving to all these different charities and keeping track of all the different receipts. Once it's in the donor advised fund, you are then giving that money away. You no longer have to keep track of those receipts when you give that money away. Donor advised fund too, once you get your money into it, it can allow you to donate anonymously. So if you don't want somebody to know that you've made the donation, you want to keep your address and phone number and all of that secret, it allows some flexibility there too. So hopefully you enjoyed this video. Just another way to say, hey, how to think differently in regards to your money, how to still do what you're doing, giving to a great cause, but looking at it differently to now hopefully also get a tax deduction for doing so. So if you enjoyed the video, like to see others just like this, or how to reduce the taxes on your IRAs and 401ks, don't forget to subscribe to our YouTube channel. We're coming out with new videos each and every week on topics just like this, as well as other retirement topics. Thanks, and have a great day.